Thank you very much. So good afternoon and welcome to you all to a new appointment of the series Women in Finance, organized by the Florence School of Banking and Finance. My name is Elena Carletti. I'm a professor of finance at Bocconi University, and I'm also the founding director of the Florence School of Banking and Finance. I'm delighted to chair the series in Women in Finance, and in particular the lecture today, and would like to start by warmly welcoming our speaker, Petra Hielkema, and thank her for being with us today, despite, I imagine, a very busy agenda that you may have as a chair in the chair position you occupy. So Petra is the chairperson of the European Insurance and Occupational Pension Authority, EIOPA, that is based in Frankfurt, and she has been in this position since 2021. In this position, she's also a member of the ESRB, the European Systemic Risk Board, the Steering Committee, and the General Board. And she's also a voting member of the IAS Executive Committee. Prior to joining EIOPA, Petra was Division Director of Insurance Supervision at the Dutch Central Bank. She joined the Dutch Central Bank in 2007, and then she took several positions in the DNB up to the latest she had before joining EIOPA. And prior to that, she had an international career, financial advisor, in particular to emerging economy. Now, what is the topic that Petra will talk to us today? The topic is data digitalization and supervision. And we all know that technology and artificial intelligence have pros and cons. The pros are certainly that technology and AI are the core tools for innovation. They are opportunities and growing opportunities for companies, consumers, but also supervisors. They are very useful tools for risk management, for controls, for compliance, and so on. But on the other hand, it's also true that the use of AI and the use of technology also bring in a new risk. So at the end, is a question of balancing between the use of technology and the AI and the opportunities and the better risk control they provide, and on the other hand, the new risk they bring in. Now, why do we talk about this in the insurance sector? Because the insurance sector has always been a very much data-led industry. And therefore, topics on technology advancement and the use of AI are particularly important in this context. So we are very glad to discuss this today, AI in general and the insurance sector in particular. I think insurance sector is something that typically we know less about. Typically, I mean in general, the general public, we know a lot about banks, but we know much less about insurance companies on average. So I think this, having Petra and talking about this today is actually very, very useful. Before giving the floor to Petra, let me just say a few things in housekeeping. We will start with Petra giving her remarks for about 30 minutes or whatever she needs, and then we will open the floor for discussion. So I invite the participant to use the chat box and put their questions so that I can read them to Petra. And Petra, the floor is now yours. And thank you very much again on behalf of FBF for being with us today.
Yes, thank you, Elena, and it's my pleasure. It's my pleasure to be here today. I hope you can hear me well. Excellent. So it's also a pleasure to actually talk about a topic that is dear to my heart, digitalization. I have some slides that will be shared, and thanks for supporting me with that. But this is the topic that I want to start with, data digitalization and supervision. Maybe as a start, briefly, EIOPA, European Insurance and Occupational Pensions Authority. It's the sister of EBA and of ESMA that you hopefully also know well. All three created in 2011, straight after the crisis, recognizing that if business in financial services business is cross-border, you need structures that also make supervisors work cross-border. Since a lot has happened, EBA also saw the banking union happen. ESMA grew on CCP supervision. EIOPA also went its own path. And I would say that when it comes to the Consumer Protection Authority part, to the prudential part, but also to data collection, we play a key role, I would say, in the absence of an insurance union. EIOPA is the place where supervisors coordinate. EIOPA is a place where if EIOPA decides, in reality, it means that I do that with my board. So 27 national competent authorities with me. We are a supervisory community, and we take care of advice to Parliament, Council, and Commission on all the topics within our mandate, on our own initiative or when asked. We work on convergence. If needed, I can also help deal with conflicts between members. And finally, we are the face also for those who are not from the EU, but are into insurance or pension supervision. Mostly insurance is international. So that is where we are. And of course, in that arena, be it among me and my members, what do we see happening? What do we need to do? Be it internationally, what is currently on top of the agenda, or when it is in advising to Brussels, data, digitalisation, and the supervision of that is a key part. So let's move to the next slide. The overarching theme of today is indeed the data, and I will take you through what is the scene, where are we today, regulatory framework, but also what is our strategy as EIOPA. First of all, we will then look at what's happening with data currently in the insurance industry in Europe, moving on to what is happening in the sector when it comes to digitalization, and then ask the question, what does that mean for the market, but then also for supervision? And if you go to the next slide, and when we look at setting the scene, I'll give you a snapshot of the regulatory context and say something on our strategy. But first, look at the major trends. I'm not telling anyone who's interested in this topic, I think anything new, but it is important to see that there are several trends that build on each other and strengthen each other. There's new IT capabilities. We all know that. We all are probably having projects in our offices to make better, efficient use of the processes that we have available, more computer power to deal with data, etc. At the same time, we have more data, and we can also analyze those data better. And here it is interesting that in January, the World Economic Forum posted that one of the they published the 5 professions that will be mostly augmented, so will really benefit from the use of AI. And number 1 was insurance underwriting. Is that a surprise? Should not be. Insurance is in the end pooling of data, analyzing data, and then managing risk. So it is for decades the industry that has been working with data, and clearly more data and improved data analytics can help also to augment that business. Now, because of that, we see new financial products, new services, sometimes also new players, which is relevant, and sometimes it's completely new, and then we need to really think about what do we want with that. But sometimes also it's a new environment that we operate in. So that is the third. And finally, of course, that has an impact then on how we sell, what distribution channels do you see, what business models are developing, including also the big tech. So if you move on the next slide, what does that then mean from a policy perspective? And this is not an easy slide to read, maybe, but this is as simple as I could make it for you. And what I try to do in this slide is I try to show you how we, currently what is happening in Brussels on the regulatory side, regulatory landscape. It's very much an at a glance. This is a caveat. And a snapshot. So for example, DORA, or overall operational resilience, so cyber resilience, is not even in here. I really focus on data and digitalization. But then if you look at the slide, what you see is where it comes to mandating and promoting data sharing, we have several acts: the Governance Act, the Digital Service Act, Digital Markets Act, GDPR, Open Data Directive that is on its way now, VIDA is on its way, Data Act. So that is promoting it. Then there is the processing, again, GDPR and AI Act, but there's also an Artificial Intelligence Liability Act on its way. And then there is the need to also promote innovation. And here the Commission indeed has seized that ASAP, so the single access point for data, the PSD2 review, and also the VIDA, the open finance stream of work, but also creation of data spaces, thereby enhancing possibly new opportunities is part of that agenda. This is the policy context. Now, I know the saying that we often hear that regulation might be, and this is a lot, might be impeding innovation. But I think what I really think is that this is too simple explanation of what is currently happening, because there's also benefits in regulation, and it's all about the balance. And if you're interested in a discussion on regulation hindering or not innovation, I can very much recommend an article from Anu Bradford, who is a professor, and she is both Finnish and US professor at the University of Columbia. She published that in April. If I'm done talking, I could also try to share the link in the chat for you. I found it a very interesting article because she compares the upcoming of the tech industry, of the technology business and the tech giants in the US and the EU, till the point in the 90s that, or in 2008, that we started to regulate in the EU. And what she identifies is that before there was regulation in the EU, also the innovation didn't fly as much as it did in the US. And she indicates certain factors for that, which includes the absence of a real single market in the EU. You still have 27 markets, the need for knowledge, good knowledge, and good people. And here she indicates that the US was able to also, through immigration, attract a lot of very, very smart people to help develop. She indicates that the bankruptcy failing in bankruptcy law is very important to also have. And finally, it's access to capital. She does not conclude that it's not regulation that might be hindering innovation and the uptake of tech, but she is saying that it's a lot more it's a lot more complex than just saying it is the regulation that is hindering. And I always keep that in mind as a supervisor, but also as an advisor for regulation, that it is exactly that. It's striking the right balance, and you always need to ask yourself, are you, when you deal with regulation at the time when so much new technology is also coming in and benefiting society? And I'll get back to that at the end of what I want to share today. But as I said, we need to work with that as supervisors. And so if we go to the next slide, what you'll see is these are EIOPA's priorities. This is what we work with as a supervisory community. And you see that digital transformation is one of the 6 key priorities in our system, but we went further. And if you then go to the next slide, what you see is we identified that is, we are very much the data hub for insurance and pensions data. And so, but in general, given the relevance of data and the importance of data for these, to harness the benefits of innovation, having a European data ecosystem that is sound is very important. We said proliferation of artificial intelligence while keeping in mind financial inclusion. That's the second priority in that digitalization agenda. Naturally, there's financial stability and resilience. This also includes the cyber part. And with that, we want to realize the benefits of a European single market at a time that competitiveness is very important. And in order to be able to do that as supervisors, we need to enhance supervisory capabilities. Now, that is why, and you can see that on the next slide. Did I switch to different languages? No, oh, sorry, my system is telling me something. I'll go back to you. Zoom was telling me something, but I'll ignore Zoom for now. If you can't hear me well, let me know. So if you look at EIOPA's digital strategy, what we did is, and it's very simple, it's a 1, 2, 3, 4, 5. 1, we brought everything together in one digital strategy. And when I say everything, I mean, we had a cyber strategy, we had a data strategy, we had a digital transition strategy, we brought it all together last year in one digital strategy, and that is based on two principles. First of all, we are technology neutral, and technologically neutral means that we, in the end, I don't care if you come to underwriting your risk on the basis of hard work by heart and a pen and paper, an Excel spreadsheet, or an AI tool. I want you to follow the same rules when it comes to data quality, transparency, non-discrimination, fairness, etc. So the tool you use, I'm neutral to the tool you use. I'm not neutral on you following the rules that you need to follow when you do underwriting. That is what technologically neutral means. And then the focus is people first. So people first. We are a consumer protection authority, and so people first is very relevant. It doesn't mean we don't think that other developments are relevant, and I'll get to that when I talk to the priorities. The second part is flexible yet firmly rooted, which means in digital language, we need to be agile. So you want to have a set that you work on as supervisors in Europe that is as harmonized as possible and rooted. So there's some certainty in it, while at the same time you need to be flexible because we do not know the speed of developments, what developments, the impact of developments in innovation, and you do not want to hinder it if not necessary because of consumer protection or financial stability. You really want it to just take the course that it can have, and so you need a base, but you also need to be flexible. Now, with those two principles, we then set three priorities. And the first one is ensuring innovation is in the interest of citizens. And this is what I meant with when I said people first. I do not think that we don't need innovation. And I'm just thinking that as a supervisor, I do not need to promote innovation. I think the industry itself can take up innovation, bring it further, promote the innovation. And we stand ready then to make sure that as supervisors, we can also continue to supervise in a technology neutral way, dealing also with new technology. But what we do need to monitor, and that is where our focus will be, is that the developments are still in the interest of citizens and that there is not, for example, use of data that have nothing to do with risks for pricing. And the example you always hear is that when you set the price of an insurance policy, you should not use data on how likely the client is to leave you when you raise the price by 5%. That is not information that is based on the risk of the product you're selling. That's data that is maybe interesting, may seem as an opportunity, but it's not fair to price in that way, and you should not do it. And we issued an opinion on that. So it's an example how we say that innovation is good, but we focus on the interest of citizens. The second priority is strengthening resilience. This is where cyber resilience, operational resilience, and also the DORA Act is very much part of that work stream. And finally, but very importantly, enhancing supervisory capabilities. And here also the Florence School of Banking and Finance plays a crucial role because together with DG Reform and the other two ASAs, we created this program for supervisors to the Digital Finance Academy to enhance their skills, recognizing that all the new skills needed, we should not only hire them, but we should also train them within our office. There's four actors. The four actors are very simple. They're consumers, there's industry, there's supervisors nationally, and then there is EIOPA. We all need to be part of that, and that leads to the 5 roles, which are on the next slide. And then what is EIOPA's role? Well, we monitor the developments, we share that. I'll share some in a second. We do facilitate also the access to innovation if there are unnecessary limits also in regulation that limit the innovation or potential in the market. You can talk to us. We foster that dialogue. And we also try to do so in a harmonized way in the EU, which is also appreciated by our members, who all need to deal with these new developments, and bundling our knowledge and our expertise and then sharing that with the community of national supervisors is one way also where we as a supervisory community can stay up to speed with these developments in an efficient way. We're a promoter fostering innovations that are beneficial to consumers. You may appreciate that the word promoter in itself did result in some discussions in my board. Are supervisors promoters? But we use the word here because what we say is we need to target it constantly from the focus of, is there an additional benefit for consumers? Bring that focus in to the extent that is not already happening. We contribute, of course, to the digitalization of national supervisors, as I said, also by sharing. So we have open source platforms where our supervisors can share tools so that others can benefit from them as well. We do presentations, and we have very, very regularly what we call our digital hour, which is an online session where we share the latest developments, and we also do some deep dives in new technologies. And finally, of course, we need to implement our own digital transformation also ourselves. We are running several projects, including currently a subtech program where we try to make use of all the through screen scraping of all the information that is available online on PRIPS kits, and see if we can then learn some lessons of what we collect. We also have an in-house pilot for the use of ChatGPT, and of course on the data processing side we continue to make improvements. Now that is on EIOPA, and then let's look at Europe. What's happening in Europe in the insurance industry? So let's move to the next slide, and maybe another one. This is just a very simple slide, isn't it? This shows the increasing availability of data. We go from a small circle to a very large one. And I don't think even this picture tells you everything, but if I tell you that a zettabyte has 27 zeros behind it, 27 zeros, then maybe you can imagine that the number of data, we're just talking a lot of data. Now, moving to the next slide, what kind of data exactly are we then talking about? And I think this is interesting, not trying to make you ruin your eyes on a too small text on a slide, but what you can see is that on the left side, what I show is data normally gathered by insurance, so on transaction, log data, all kinds of data that we get. And on the other side, what you see is personal data that you can collect in many ways these days, but also simply by asking consumers questions. And then what we've seen is that close to 70% of consumers is actually willing to share a significant amount of personal data in exchange for lower premium. So it's the mix, and also going forward in the future, it will be the mix of combining these data and then analyzing again that will bring further opportunities. So that's a lot of data, and they are then increased also by how they are used, as you see here. And then moving to the next slide, what about digitalization and the sector adopting digital technology? And if you move to the next slide, what I want to share here is some highlights, very, very sneak preview overview of the digital market monitoring survey that we did. We did that last year. And I'm very happy with everyone who contributed. If you really want to know the nitty-gritty, please go to our website, and there you will find the report. But what we tried to do, and the last one was in 2018, so what we tried to do was to do an update of what is happening in the market, in the insurance market with digitalization, see the opportunities, see the risks and barriers to innovation. And what we did is we did a market survey to the insurance undertakings, and 209 responded, 22 member states involved, so that was excellent. And we also did a Eurobarometer survey, and there about 1,000 interviews were taken with EU citizens. Now, if you go to the next slide, what you'll see is that we asked the firms, how important in your firm is the digital transformation today? Do you have a strategy in place? Will you have a strategy in place? If not, and here you see the outcome. You see that already over 50% has actually a dedicated digital transformation strategy in place. They say then that they have that because the focus will be, first of all, improving customer experience, and then of course also try to create more value for the company. They also indicate that one of the main barriers to this, to implementing the strategy, is to actually attract the talent that is needed to make this happen. If you then move on the next slide, what you see, and I'm really not making you try to make you ruin your eyes, but I think this is interesting because consumers still predominantly, if we talk to consumers, prefer to buy insurance products via physical channels. Even though online tools are there, the expectation is that there will be an increase in sales, and that there are definitely different shopping habits. And I also think there will be different shopping habits depending on what you want to buy. If you want a travel insurance and you're about to leave, it's super convenient that you can buy that on your mobile phone. If you have a damage to your car, it's excellent if you can just send a picture to the insurance company and you can get your and you already have your claim handled. At the same time, if you want to have a financial planning that includes some robustness for accidents that happen, theft, loss of a job for a certain period, and long-term having a good retirement scheme, this is where people tend to want to talk to a person. And moreover, when there is larger damages happening to people and they need to hand in the claim or get help, they want to talk to a person. So even in a digital world, predominantly physical channels are essential. And I think, for example, in the context of the retail investment strategy discussion, it is important to recognize this, that advice that is a key part of the role of insurance when people plan their finances, and if they do that well, their peace of mind, that the service that is provided in the form of personal advice by a person also has a value that can be recognized. Now, if you then look at how much is the phone used on the next slide, we see that a majority of people do not yet have a mobile app. Also, not all insurance, in all honesty, have a mobile app. But again, if people need to talk to an insurer face-to-face, telephone, or an email, but interaction with a real person still has the preference of the European citizens. And again, differences per countries. Now, this about the consumers. We also checked how much are the big techs currently involved in this market, and we show that on the next slide. So, and we asked the firms, can you tell us, as a firm, what is your interaction with the big tech at the moment? Now, and this is where actually a lot is happening. We see that almost 80% of insurers are outsourcing cloud computing services from the big tech, cloud computing, but also data analytics. They are already very much part of the insurance industry, and they are expected to grow significantly in the future. Now, some big tech have moved to also get a license, but most of the time we see them actually in the back office supporting the insurance, and which is very relevant, and which is also why I feel that the Digital Operational Resilience Act doesn't come a moment too early. For digital resilience, operational resilience will be very key, with a concentration of risks in critical third parties. When it comes to insurtech, we see different profiles, we see different strategies, and I think that is the beauty of a diverse landscape. And I think so there is not a dominant player happening or a dominant strategy, but when it comes to cloud services, there clearly is. Now, moving on, finally comment on the use of AI. How much of use of AI? And here we saw significant growth. In 2018, I think 30% was either using it. There was a proof of concept, 25%. So we thought we did see already an announced growth to the 50%, but we now see that in non-life, 50% is indicating we use AI, 24 in life, and it's expected to increase significantly again over the next 3 years. Now, if you look at how they are used, you see that there is still human oversight, and particularly in those cases where you see that there is a high risk AI, you see involvement of the board. Now, how is it used? And here, let's move to the next slide. Again, if you look into our report, you can read this better. But I think what is relevant is that as supervisors, what we said is that as long as it's used in the back office of an insurer to make processes more efficient, to help with good data analysis, but it's not really yet in the services to the client, we can lean a little bit back. But once it is moving to the front office, we should. And if you look in this chart, the yellow is customer service, the orange is the pricing, and the middle blue, the royal blue, I would say, underwriting. I think these are all areas where there is really an impact on clients upfront, and the green is where you actually do the claims management also once a client is a client and has a damage. So I think what you see clearly is that the use of AI in insurance is moving from the back office into the front office, meaning that we need to be on our feet as supervisors, and indeed make sure that that it is used in a proper way. Very popular are the chatbots. What we also see is mostly it's developed in-house, but more and more, better AI is also helping insurers to improve how they accept risks. So that makes governance very important, and that makes us go to the next slide. So and if we go to the next slide, you will see we ask questions. Do you have a data strategy and an IT strategy in place? Do you also have an AI strategy in place? And here, if you look at this chart, you see that data and IT strategies very much in place, AI strategy is still lagging behind. So there's one thing I can recommend to my industry, it's that they should make sure that they also have an AI strategy in place. And in that, you should also indicate as an insurer what is the involvement of different staff members. And currently what we see is that really very much depends on the use case. As well as on the way the insurer is organized. The good thing is that, as I said, the really high impact AI are almost in all insurers the responsibility of the management and executive board, and I think that is a good decision. So that is where we are now. Does this mean? And you saw Gardner, we make use of Gardner, you saw that on the slides. They talked about an explosion of the use of AI in the insurance industry. As a supervisor, I would, in any case, avoid the word explosion, of course. I think it's really growing. But what does it mean for the sector? So let's go to the next slide. There's an in between, and then the next one. So first of all, for the insurance, I think we see new data and new technology leading to more sophisticated use of data and therefore understanding of risks. And it also can include Internet of Things, behavioral data, and that requires very good governance in which you decide what you use. Moving on. As I said, if we then look at, moving on in the slides, if you then look at the AI governance, things that you need to consult is, need to consider when you use it are here on the slides: fairness and non-discrimination, the human oversight needs to be transparent and explainable. Data governance and record keeping is important. Your robustness is important, as is proportionality. Now, we didn't make this all up ourselves. Here we actually worked with a very good consultative expert group on digital ethics. That means that we worked on this together with industry, and we set these principles actually before the AI Act came into being. But I'm happy to say that the AI Act actually includes these notions as well. Sometimes, for example, I get questions about the explainability. If AI further develops, then there is a risk, the black box risk, that you can no longer really explain what is happening. Well, sometimes, and I take the example of certain cars can drive really, really fast. But do you use them on normal roads? Do you use them to take your kids to school? Or do you use safer cars to drive them? And so I think you can also choose to not use a certain technology yet, or a further developed technology yet, if it can't keep up with these principles of ethical use of AI. And why is that? And that brings me to the next slide, because there is the risk, also from a supervisory perspective, of financial exclusion. And more data use can also result in exclusions. It can also result in prohibitive pricing, meaning that because more is visible of the risks, you are better able as insurance industry to pick the good risks that also, help you make a good business, and you can leave out less good risks or risks that will cost you money. And with that, some of the risk pooling, that is the mechanism, will disappear. Price optimization, I already meant that. So using information data sets that are actually not related to the risk of the product, but they are related to the behavior of the policyholder behind the product, using those to actually price a product. We publish we call it price optimization, but we need to carefully look at that also as supervisors. And you see some activity in several member states where supervisors are acting to make sure that that this is not happening. It just doesn't help the confidence in products. It doesn't help fairness in the market. If you sell a product, it has to be fair value for money, and it needs to have a fair price. Maybe moving to the next slide, and this is again about fairness and what that means. I often get the question that now with the introduction of the AI Act, there is an additional regulatory burden placed on insurance, and that is an issue. I look at it, frankly, much more pragmatic. I think, first of all, that the AI Act was created with any user of AI in mind, including parts of the economy that are not regulated, that are not aware of the rules that you need to follow, are not aware of the need to consider fairness, to consider bias in data, or even to consider fundamental rights that are here on the slides. But and we do already in insurance, and that is why EIOPA also indicated that identifying insurance as a high risk in the AI Act is not per se necessary, because we feel we already as supervisors have the power to act on all this. But if you turn that around, it also means that with the introduction of the AI Act, where health and life insurance is now identified as a high risk, the fact that now the AI Act says that you need to consider fundamental rights when you develop products and sell products, that should not be a novum. That should already be happening. I mean, the fundamental rights were there before the AI Act came in and will come into being. And the same holds for racial equality directive or a gender directive. I think it is important that you do not discriminate. If you can go to the next slide, please. Now, what is more complicated is this discussion. And now I go into a bit more detail, but bear with me. This is the right to be forgotten discussion that is taking place at the moment. And for those who are not fully into my industry, right to be forgotten. Right to be forgotten means that if you are an insurer and you want to insure someone and you are doing the onboarding, you can ask, do you have a history in cancer or not? And if you say, yes, I do, then they can ask, and have you been declared already cured? And how long ago is that? And then you can say, well, the last time I had bad news was 10 years ago, and then it stopped. And already for 10 years, I'm fine. Or for 5 years, I'm fine. Or for 2 years, I'm fine. Now, for some insurance in the EU, depending on which member state they are in, it means that if a customer says, well, actually, it's already 10 years ago that I had any bad news, then they will be considered as a policyholder who never had cancer. And in some countries, it's 5 years. But in other countries, there is no right to be forgotten. It will be forever on your list, and it will forever be input in the acceptance procedure of the insurer, but also in the way they will price for you. Now, there's a big discussion currently going on in Europe whether or not that is fair. And there are proposals to actually limit the data that can be used for price setting and underwriting by insurers for survivors of cancer. This is, first of all, I think, an emotional discussion, and I think this is the core of what our future challenges are. That's why I stop a bit at it. Because, of course, unfortunately, I would say almost everyone in Europe has someone they really care for that had to go through this horrible disease. And then finally they make it through and they're back and already for years. And then they want to buy a house or they need a mortgage. And then they have issues because the insurer doesn't want to insure or you don't get the mortgage. Is that fair? Some say it's not. Some say that actually the amount of data that we currently have as an insurance industry actually indicates much better that there are many survivors of this horrible disease. And because there are many survivors, you see that you can survive, so you can insure. And there are also those who say, well, there's always the risk and you need to know. But in the core, I think what you need to decide as a society is, first of all, do you want insurers to be able to see the risk and to monitor the risk and to have the data also over years, so the access to data? And a second question as a society you need to ask yourself is, do we want to then intervene on the price setting? So can they see it? Can they also use it for pricing? This is a discussion that is taking place. This is not a discussion for a supervisor. This is very much a societal question that needs to be decided at the political level. But what I do feel is that what we need to make sure is that while we have this discussion, and you've heard me say a lot about fairness when in using data, and we look for that, we should not forget that at the same time, the role of insurance in our society is very important. It's mostly invisible, but it's very important. Every society has losses. Every society has damages. And the question is, how do you pay for that? That's because the cost will come. But you need to ask, how will we pay for that? And the cost will come unexpectedly with different individuals. It's like a deck of cards. You get a bad card from fate, or you get a good card from fate. But insurers have the whole deck of cards, and they bring all those cards together. And then with those cards together, they set the price for the total pack and say, with that price, we can cover for damages that follow out of a few cards that were the bad cards, and those people will benefit from that. So it's the risk pooling that they do, and then with that, managing the risks for society, providing ease of mind, and so we can go about our business, do our business. And in order to do that, you need to have at least the access to data. And you need to do that in a fair way. Do you sometimes need to be encouraged, even for regulation, to do that in a fair way? Maybe yes. And when that is, that depends, I think, also on the line of business. So I think maybe society will have a stronger voice on this when it comes to health insurance than when it comes to a car insurance. But I think this is a debate we need to have in a balanced way, recognizing the benefit of having this industry take care of our risks by actually sharing it. We're in it together, we pay for it together, and then I think in an efficient way we can manage losses, while at the same time benefiting even from more data, being even better pricing, but at the same time also preventing a misuse of that ability of granularity, and also recognizing that it could sometimes lead to exclusions, and then ask the question for politicians whether or not that exclusion is acceptable or whether or not you need to intervene. And I think that is the basis of the right to be forgotten discussion that is ongoing. But I also think that that question, how much granularity is acceptable to society, while at the same time recognizing that that granularity can also help good risk pooling and good pricing, that is the question we continuously will have to ask us while we are en route of more data and more granularity. Now and maybe here we go to the next slide, and then another one, I think, just move further. I'm wrapping up almost, one more. Yeah, so we, looking at that, I just said, the big choices, we can help them being informed choices, but they're not for the supervisor. What is for the supervisor is to keep pace with all these challenges, supervise the proper use of. We do that internationally, we do that in dialogue with fintechs, and we learn together. And then if you move to the next slide quickly. So at the international level, I actually chair the FinTech Forum, and we are currently drafting an application paper for AI in the BIS in Basel. We hope to come out with documents next week, at the end of this year, in the next big general meeting. We also monitor the use of DLT and open data. That's not that much flying yet, also not worldwide. If you move on and you look at what we're doing in Europe, just to flag, we have an initiative called Forum for Innovation Facilitators. This is a forum which is very much for supervisors. We provide the ability to have sandboxes that are cross-border, ability to test together. In all honesty, it's not being used that much yet, but we are currently chairing it. We're looking into why is it not used? What can we do? And we continue to identify new technologies. Moving on, I already mentioned it. Oh yes, you can move on one more. Thank you. The academy, where we have together with the European Commission, DG Reform, together with EUI, and but also with EBA and ESMA, we provide already now the third cycle of trainings, but also some more deep diving advanced trainings and workshops for supervisors to learn. And there's much focus on AI, I can tell you. And finally, maybe on subtech, which we do ourselves on the next slide. I refer to that as well. We will continue also to deal with that. What is subtech? Subtech is the use of technology by supervisors to supervise. And here we can learn a lot from each other. We have some more digital markets in Europe where also the supervisors are using more digital tools. What I always find one of the challenges here is that on the one hand, if you want to make supervision very efficient and you can make it very data-driven, that will increase the reporting. But once you have that increased reporting, I think you can have a lot less interaction with the supervisor, and also you can have a supervisor who's easier focusing on the real risks and therefore being better able to implement risk-based supervision. Particularly for the smaller entities, and insurance and pension funds are known for a lot of smaller players, that is a bit of a challenge, because on the one hand, we want to keep the reporting requirements as little as possible, which means you have a lot of additional supervision. Now, if you want to reduce the amount of supervision, you would have to increase the reporting. Currently, the mindset is still, and you see that in the Solvency II directive, less reporting. But that means that also that when it comes to subtech programs for making supervision of smaller entities more efficient, you need to be innovative with less data than you would have for the larger ones. Now, if we skip over the next slide, we come to my final slide where I conclude. So digitalization offers many opportunities, particularly for insurance, which is actually an industry that collects data and then uses the data to do its work. It brings challenges. It brings challenges to an industry in a time that people themselves have all become more conscious of what it means to share data, that there are risks when you share data. And they think about that, and that leads to questions. But all in all, I think it's I think all in all, it's a challenge we need to take up on and find the right balance. And we do so through dialogue, through cooperating and learning. And that is what we do also with the Florence School of Banking and Finance. And Elena, I'll stop here.
Thank you, Petra. Thank you very much. I have to say, I found this speech particularly interesting. And I don't say that because it's you in front of me, but let me explain why I find it particularly interesting. So I spent my life studying microeconomics and information asymmetry, okay? And therefore, I've always thought that trying to reduce asymmetric information, which goes to the use of data, and trying to separate types rather than pooling them, is actually better. And we have a Nobel Prize in economics saying that we actually want to try and separate types as much as possible, because it's not just a matter of pricing better and pricing the risk return better, but it's also because otherwise we risk that if there are too many bad types on the market, then we risk the market collapses if you cannot separate the types. But listening to you, I had the impression that it's actually very different, because in listening to you, I had rather the impression that, as you say, here we are talking about consumers and people. So you cannot possibly try to separate everything completely, because otherwise you go into exclusion of some types that may just simply be because they had cancer and now no longer have, or whatever. So the discussion is very, very different relative to, let me say, the normal standard economic idea, or even if I apply it to banks and borrowers are companies, you wouldn't want banks to finance bad companies, right? So you would like separation as much as possible. But from what I understand, and correct me if I'm wrong, that is a little bit different. So you actually would like some pooling, because otherwise we risk to exclude from the market individuals that deserve an insurance and wouldn't be able, for one reason or the other, either to have it or to pay too much. So that is which brings a discussion on a completely different level, as you said, which is very much on political level and society, because we need to understand what it means for society. Having said that, of course, insurance companies are also profit maximizing institutions. So it goes into this financial versus more society objective that if you, that is the typical situation where you would have then public support of some form, right? I suppose, because ultimately that's what you do when you have a sort of market failure of the type you are describing. But I thought the framing and the right to forgotten example is clearly a clear example of this, is actually very illuminating. So thank you for bringing this to the attention, because it's, for people that are not used to think about insurance, it's a very different paradigm of thinking, in my view. But having said that, I have maybe a few questions here and there that maybe I can ask you. So going back to this pricing issue, now forgetting about this exclusion part of it, I sort of understood from even before going to the right to forgotten and these other more type of consideration, that initially you said that we don't want that insurance companies use data for pricing. We want them to use data for risk, but we don't want it to use data for pricing. But then on the other hand, when we went, for example, we look at the survey on artificial intelligence, we actually see that artificial intelligence is mostly used for pricing. And I understand the AI is a tool, the data are the input to the tool. But how do you combine the two somehow?
So of what we say is, you do need to use data for pricing, but the question is, so we're not saying you cannot use data for pricing. You have to use data for pricing. The question is, which data sets will you use for the pricing? And what we say is, it should be the data sets that are related to the risk you are insuring. So if you are insuring property in a certain area, if you use data available on how much theft is there, how much robberies, that is relevant, how much fires, how much flooding, that is relevant, because these are all risks that there will be a damage. So you have, and how much the damage is. And that is always, it's the probability of an event and then the cost of that event. Those data are very relevant. But what you can also do, of course, is you can also look at other data. For example, I have a group of older policyholders, and I know that this group in my society is very unlikely to change provider if I raise the price by 8%. So even though the risk stays completely the same, I still raise the price by 8% because I know they won't leave and I can make an extra profit.
Yeah, because that is exploiting sort of monopoly power.
Yes,
but
and
of
so
course,
that's what I meant.
Yeah, but of course you could use data the other way around for a better pricing, for increasing competition. But then how do you really do? Do you go and check case by case how the pricing was set and used? Because it makes it very difficult, right? To differentiate between the use of data in the pricing. Let's say the good use of data or the bad use of data. That is very complicated.
So it starts from the questions, and we do look at that. So when you set your technical provisions and when you do your pricing, what is the input? So what is the data you use? What is the data quality? What processes do you have in place? Who decides on the data set? So a lot of this data governance that I refer to is very important. Another project, and this is highly debated even today, there should be possibly a decision on the retail investment strategy, is what we call fair value for money. And so as supervisors, what we look at is, does the consumer get fair value for money? And that means we don't set prices, and we don't want to be in the business of setting prices. So it's always a range. But what we say is, if you compare with other products that offer exactly the same to a consumer, are you then more or less in the same range when it comes to the price? And then price, and this is important, has to relate to the cost. So the risks you're insuring, the cost, to the services you offer. Like, do you offer an additional guarantee? Do you do a lot in person, or is it all digital? And also, what are the returns? And that is very relevant if you have a policy for your pension. What are the returns that you're giving? So returns, costs, and services, though three of them related to the product, should deliver value for money to the consumer. So in-house, the data governance, the processes, and the quality of data sets, that's one. And at the end point for conduct supervisors, fair value for money, those are the tools we use to supervise an industry on providing good products for good prices.
Okay. I do realize that it's already 2 p.m. So unfortunately, we don't have any time left. And I suppose that
There's not so many questions, huh?
No, not so many questions, but there were quite a number of people listening. So I'm sure that this has been very useful for them. Maybe just if I can steal 1 minute more on when we think about digitalization in banks, for example, a sector I'm more familiar with than insurance sector, we always have this issue of the legacy, both in terms of data and also in terms of people. So how relevant is this in the insurance sector? How much of an impediment this can be for
Well, I think it's very relevant. If I talk about people, as I said in the survey we did, actually many of the participants of the industry that responded are indicating as one of the barriers to further innovation, the fact that they need to have good staff and trained staff, and that this can be an issue. So it's even hindering maybe the speed of innovation. If I look at the technology and the IT systems, for sure, there is a lot that still needs to happen in our industry. Many insurance policies, new products, every time it's slightly different. It's not that standardized. It runs on different IT structures. And these are sometimes really long-term products, products that can run for 30 or 40 years. So it's not only that you have a legacy in the sense of the basis of the IT that is already old or too old sometimes, but it is also that product still will run for another 2 decades and was sold 2 decades ago because of the long-term nature. And these are challenges in the IT infrastructure, also in the IT resilience that we need to look at, that supervisors look at, but mostly industry also is looking at, because that in itself it needs to improve and needs to be manageable. And so most of the fintech solutions and tech solutions that I see is tools that you layer over the legacy systems. And then you bring the data together, and then you can move from there. So not having to change too much on the old stuff, but being able through the layer to still create a data pool and an IT base on which you can then move onward into a more innovative running your business.
That is what's happening in the banks as well somehow, but with the difficulty of doing it, and maybe you cannot exploit innovation to the full extent.
Yeah, exactly.
Okay, let me stop here. We didn't have time to talk about the women part of the seminar, but I think you as an example already are an example. So that goes with you somehow, and maybe we will have an occasion another time. But thank you very much, Petra. I really found it is very, very interesting. Thank you.
Thank you. My pleasure.
Thank you. And bye-bye to everyone.
Bye, everyone.